Welcome back. We're joined by Alok Agarwal, Alchemy Capital Management, joining us this afternoon. It's a very decent afternoon, by the way, viewers. You need to know Nifty is doing fairly well in fine federal. Alok, really the talk of town right now is IT. How do you position yourself and what's your view there?
Yeah, hi Harsh, good afternoon. Pleasure being here.
Very good afternoon.
The IT stocks we all know has corrected massively, especially this year, and we have seen for the last couple of years itself. And apart from being disrupted or being the fears of being disrupted by the AI side, the fact is the growth numbers being reported and the visibility of the same continues to be lagging. So that's the main reason for IT stocks to remain weak. Until the time we see that growth revival coming back, it will be very difficult for us to position positively on the sector. Yes, the valuations have corrected from their peak valuations and average valuations. So to that extent, they look cheaper. But when we look at the valuations of some of these companies, the peers which are listed in US, they are still trading at a significant discount to the current valuations of the IT index. So the growth needs to really come back for us to change the stance towards positive side. Till then, we will be on the sidelines.
The impact of AI on IT, Alok. One thing is growth and probably whether that recovers or not. That's one part of the problem. The other part of the problem is revenue, which could degrow. Is that your opinion, or revenue growth will happen despite AI? And how will AI be disruptive to them, according to you?
The problems are plenty. There are a lot of coding-related work, etc. Now that can be handled by AI, so that can lead to some of the revenue streams moving out of the current IT services pack in India. At the same time, some of the revenues may be protected, but the margins could come under a challenge. So how our companies adapt? Of course, they are also doing a lot of stuff to ensure that their AI-related orders also keep rising. But how they adapt in a time when things are a little disruptive for them. And mind you, before the AI also, if you look at the last 3, 5, or 10 years, the earnings growth of the sector was barely touching double digits. So without disruption, if something was just about a little under double digits, now with the disruption how they hold up, how they guide for it, will be the key thing to watch out for. So how it plays out has to be seen. The impact is likely to be both on revenues and margins.
Alok, do you think that enterprise AI solutions can be delivered to the world without IT services companies? Is that at all something which bothers you in terms of the position that you've taken?
No, frankly, for enterprise IT solutions to be really delivered, you would need those IT services, right? So when one talks about that the growth visibility is missing or the disruption is there, one is not saying that the other side becomes completely irrelevant. That's not the case. The case is the smoother growth rates that were seen earlier, can they be maintained or improved? That is under question. So not the existence or the cash flow generation capabilities. So those remain intact. So their IT services would be required for the implementation of these enterprise solutions. So how the current incumbent IT services companies adapt to it and ensure that they get more and more of those orders, that's the area to be seen. So that's where the commentary of the companies, their guidances, and how they achieve their own guidance, that will be the key monitorables for some of these IT companies in the coming quarters.
Interesting. Other sectors, pockets, how are you looking at the market as a whole? We can go on and on about IT, but talk to us about the market as a whole. How are you seeing the market at this juncture? How is risk reward looking in various parts of the market, large cap, mid, small?
So if you look at the markets in general, last 2 years, Indian markets have significantly underperformed the global markets and the emerging peers. A lot has been said about it, but the fact remains that a close to 60 to 70 percentage points underperformance on an absolute basis in last 2 years, that itself makes the risk reward quite attractive for the Indian markets. Absolute basis, we have barely increased anything in the last 2 years. But yes, there have been a lot of proactive steps being taken by both the government and the RBI to ensure that the growth numbers come back much faster than expected. there had been challenges, be it on the trade war front or on the rising crude oil prices, but all have been navigated pretty well. And we can see some of the green shoots in terms of corporate earnings numbers as well. Even the last quarter, the Nifty 500 delivered a close to 15% earnings growth. So the numbers seem to be coming back. While GST collection numbers, which we follow as a proxy for how the economy is doing, well, those numbers still continue to be in a single-digit growth numbers. But if you look at the sequence in the last few months, month on month, they have been improving. Another factor that is showing some green shoots of growth is the fact that the credit growth numbers have started inching towards 15-16% mark on a sustainable basis. So the growth marks are coming back. The higher valuations in Indian markets have got corrected themselves through a time correction of close to 2 months, 2 years. So due to which the risk reward continues to be attractive. Some of the leaders in terms of index heavyweights, in terms of those sectors, they are the ones which are not being able to grow at a faster pace. But deeper down the broader markets, some of the sectors are doing pretty well and growing at a good pace. So that's where we see that the risk reward is attractive, but the action is more in the non-index names.
Okay. And Alok, in terms of sectors, themes, what are you liking at this point? Is it something, now that we've got a large part of the war overhang going behind us, crude also cooling off substantially, are you more constructive overall as well versus what you were maybe a month ago?
Yeah, the uncertainty that was attached to the war and the fact that the crude oil prices went up, which actually impacted India disproportionately, at least that part going behind is a welcome positive for the Indian markets. Apart from that, the sectors and the areas that are showing the kind of growth, we all know, if I look at them one by one, globally, the growth engine has been the AI engine, and India fits well in that AI engine through its power segment as well as the metal segment. The second major theme globally that's going on has been the fact that there has been a rising geopolitical tension. And we know that the defense theme is the one that has a much, much longer legs, or maybe a 10-year plus growth story ahead of us in India. Globally, 2.5% of GDP is spent on defense currently. During Cold War times, it used to be close to 6%. With the fact that US being withdrawing their protection cover, security cover from the NATO countries, it wouldn't be surprising to see defense expenditure to GDP rising closer to 6% in coming years. And it's all coming at a time when India has been investing a lot in improving its own production capabilities and exporting capabilities. So that's where the longer term growth opportunity is there in that sector. Domestically, a couple of other themes that's doing pretty well has been the financialization of savings. Indians have been savers predominantly always. Earlier, the savings used to get channelized primarily towards the savings accounts and fixed deposit accounts. And they are now increasingly more and more getting channeled towards the capital markets. Earlier phase, when the deposits were being accreted at the banks did so well. In 2004, their weightage was close to 4% in the index, which rose to close to 20% by COVID. And now that same amount of savings is moving more and more towards the capital markets. That's where the capital markets whole value chain is actually benefiting a lot, and there could be a longer runway of growth for them. And lastly, I do see a lot of opportunities in the pharmaceutical space, especially on the CDMO side, as well as on the API and the CRAMS side, and as well as domestic hospitals. So some of these names that I just mentioned, a lot of them are not really there in the main index heavyweights, but a lot of action, a lot of tailwinds, a lot of structural growth ahead of them.
Viewers must know Alok is extremely stock specific. He's a bottom-up investor. So while we're talking themes, you may have to do a little bit of your own filtering before you take his advice. But Alok, a little bit more on healthcare, because that's an interesting pocket. It's already done very well. How do you differentiate the wheat from the chaff? How do you probably now start to look at opportunities once the run-up is done? How do you differentiate between what's going to work from here and what's not?
No, in fact, let me divide pharma into two parts. As I said, one is the makers of those medicines and the CDMOs and the API companies, and the other side is the hospital side. So in terms of the medicine manufacturing, we do see India has actually developed a lot of its niche and a lot of its capabilities and demonstrated that that's an area that we can produce some good quality stuff at a very, very competitive price. And a China plus one strategy there comes in handy for a lot of these companies. And the rupee depreciation is also benefiting them. But the growth visibility is the one that we look for, the ones that are delivering well on their earnings growth and where the customers are giving them more and more repeat orders, wherein the growth numbers are far, far better. On the other side, the domestic hospitals, while they get classified under the healthcare and the pharma space, a closer look shows that actually they are more of the private hospitals catering to the basically the top part of the population. To that extent, it has all the makings of a consumer discretionary, and that sector has been doing pretty well. Several years ago, it was difficult to spot very scalable kind of names, which would have kind of a pan-India presence. They were very, very localized, but now there are a number of companies which are gaining prominence and spreading their wings across multiple cities, states, and some of them almost moving to the pan-India level. So a long runway of growth on both these segments, very different, although
determine which could be good and interesting investments. Thank you so much, Alok, though, for coming in and speaking to us.